Welcome to lecture number 18, where we will be seeing module number 4 under subject indirect taxation. So module number, 4, this is module number 4. I'll just restart it once again. Welcome students, welcome to lecture number 18, where we will be starting with module number 4 under subject indirect taxation. So module number 4 is input tax credit. Now what all we will be covering under this module is introduction to input tax credit, eligibility to avail input tax credit, registration under GST, persons not liable for registrations, compulsory registration in certain cases, what is the procedure for registration, deemed registration, returns under GST, furnishing of returns, first return, revision of returns and penalty or late fee. This complete module is a theory module, students. So basically we can see that in module number 4 is divided into 3 types. That is, module number 4 is also having information about ITC as well as registration that is required to be taken under GST, and about GST returns, that is how to file the GST returns, which all returns are to be filed. So basically this module is divided into 3 parts. Now, so today we will be covering introduction to input tax credit and eligibility to avail input tax credit. So let us first see what is input tax credit. What is the meaning of input tax credit? Today I'll be giving you all a complete introduction about input tax credit. So students, input tax credit, remember, is covered under section 16. Okay, section 16 subsection 1 talks about what is the meaning of input tax credit. So every registered person, when I say every registered person, means only those persons who are registered under GST can claim credit. So the credit can be claimed only by a registered person. Registered person is a person who's taken registration under GST. Okay, every registered person can claim credit of tax paid on purchases on input services and capital goods subject to certain terms and conditions. So by this meaning of ITC, we understand that only registered person can claim the credit. Credit of what? Credit of the tax that is paying on the purchases. Now, what is the difference between input services and capital goods? So see students, inputs are those goods, okay, which are used or intended to be used by the supplier, okay, in the course or furtherance of the business. So input he is going to use in the course or furtherance of the business. Similarly, an inputs means it is goods. When I say that he is purchasing some inputs, means he's purchasing input goods, and such goods are used in the course of furtherance of the business. Now, when I say input services, means any kind of services that is used in the course or furtherance of the business, it is used by the supplier. Now, when I say capital goods, now obviously capital goods are different from input goods. Capital goods means goods which are capitalized in the books of accounts. Of whose books of accounts? Of the person who is claiming the credit, okay, and they are used not for sale, okay, they are used so that they help the business to grow. So capital goods, usually when you're purchasing, you're not purchasing with an intention to sell it, you're purchasing with an intention to use it, okay, in the course of furtherance of the business. Now, capital goods are capitalized in the books of accounts. Means capitalized in the books of accounts means you're going to treat it as an asset in your books of accounts, students, because you're going to, with the help of capital goods, you're going to process the inputs, or capital goods are going to help you carry on the business. So input goods are different, input services are different, capital goods are different. So a particular supplier, he may either procure some goods for his sale, he may either take some services Okay, or either he can take capital goods. Now whatever he is purchasing, he is eligible to claim the credit of that. Okay, but it is subject to certain terms and conditions, and these terms and conditions we will be seeing now in the succeeding slides. So the meaning of ITC is very simple. ITC is the input tax credit. See, when you're purchasing, goods are coming in, so there is input, correct? And whatever tax you're paying on the input, that is whatever tax you're paying on the purchases, government is going to give you a credit of that. Going to give credit to whom? To the registered person while making the payment of output tax. Now let us see ahead. Now, section 16 subsection 2 talks about eligibility of claiming ITC. What are the basic terms and conditions? Suppose I am a registered person and I have made certain purchases. Okay, so I am eligible for credit. Now what are the conditions that I have to fulfill, okay, upon which I can take the credit? So condition: ITC can be claimed only by a person registered under GST if he fulfills all the conditions as mentioned below. Okay, so number one, the dealer should be in possession of document. Refer rule 36, we will be seeing in the succeeding slide. Students, when suppose for example I am purchasing, okay, some spare parts, okay, for the further sale. Now when I'm purchasing the spare parts, the purchaser, I am the purchaser and someone else is a supplier. Now when he is selling such spare parts to me, okay, he is required to give me an invoice, correct? Now the spare parts have reached me, I have made the payment to the seller who has sold the spare parts to me, but suppose I am not in possession of the document, suppose I do not have an invoice of those spare parts, then I cannot claim ITC. So the first condition is the dealer should be in possession of the document. Now your document means any proof stating that, okay, the goods have been actually sold or actually been purchased. So invoice is nothing but a document which where it is a proof that the sale has been made and the purchases have been made. Okay, and there are different items falling under document which we will be seeing very soon. So the first condition is the dealer should be in possession of document. Now when I say the dealer, means the purchaser, because only one who is purchasing can claim the credit, not the seller. Okay, the second condition is the said goods or services have been received. Suppose, continuing with the same example, I will just change a little. Suppose I have purchased the spare parts. On the phone, I have given the order of the spare parts. He has issued me invoice. I have made the payment, but the goods and service, but the goods, that is the spare parts, are still in his factory. I have not yet received it. Government says, unless and until you do not receive it in your premises, you cannot take the credit of that. Though I have made the payment, though I have the invoice copy of it, still, since the goods are still lying with the seller, it is not yet come to me, to the dealer who's purchasing, ITC cannot be claimed. So the second condition is the said goods or services have been received. Actually been received by whom? By the person who is going to claim the ITC. Next, all the returns should have been filed under section 39. See, section 39 talks about returns, okay, GST returns, where we have GSTR 1, we have GSTR 2, we have GSTR 3B. Okay, so all the returns should have been filed. So continuing with the same example, just a change. I have received the invoice, I have received the goods, I have made the payment. Okay, I have done everything, but I have not filed my returns. I have to file my GST returns, which I have not yet filed. Still, government says that if you are not filing your returns, you cannot claim the ITC. Next, So filing of returns is very important in claiming the ITC. Now, which all returns are there and what is the due date of filing those returns, that we will see under section when we deal with section number 39. Next. The last condition is the tax charged on purchases have been paid to the government by the supplier. Now, let me give you all an example. Continuing with the same example, suppose I have purchased the spare parts from Mr. X. Okay, Mr. X is going to issue me invoice where he is going to write his output tax. Okay, suppose CGST, SGST, he is going to attach in the invoice and he is going to give it to me, correct? I'm a registered dealer. Now, that output tax has to be paid by Mr. X to the government, correct? Till Mr. X does not pay that tax to the government, I will not get a credit of that. So the tax charged on purchases, okay, whatever the supplier Mr. X is charging the tax, that tax has to be paid to the government by the supplier. So by Mr. X has to pay the output tax on that particular goods that is selling, then I will be eligible for credit. Okay, so these are the basic terms and conditions. All these conditions have to be fulfilled, then only a registered person can claim GST. Sorry, can claim input tax credit. So number one, the dealer should be in possession of a document. Document is nothing but any proof where the sale of goods has happened. For example, an invoice. It can be a debit note. It can be a bill of supply. In detail, we will be seeing now shortly. Next, the goods and services have been received. You should actually receive it. Okay, it should not be still lying with the seller. All returns should be filed, and whatever tax the seller is charging on the sale, he should pay that tax to the government. Then only the purchaser will get the credit of that. So this is the basic terms and conditions which is covered under section 16 subsection 2. So students, section 16 subsection 1, we seen the meaning of ITC. In meaning, we saw that every registered person can claim ITC on input services and capital goods. And then we seen that even if he can claim provided he fulfills certain terms and conditions. Let us move ahead. So here, can everyone see what is the meaning of document? We have to refer rule 36. So let us go to rule 36. Rule 36 tells us documents required for availing ITC. I gave you an example of invoice, but let us look into the different documents which if available with the purchaser, he can claim the ITC. So document shall mean either the following documents are required for claiming ITC. Invoice issued by supplier of goods or services. So I told you the first document can be invoice. You need to have an invoice supporting your purchases in order to claim ITC. Second is a debit note. Debit note issued by the supplier to the recipient. Now, can anyone tell me what is the meaning of debit note? Yes, we have seen in our first semester. What is a debit note? Okay. So let me tell. Debit note is nothing but, students, suppose, for example, I am a supplier, okay, and I'm supplying goods. I'm supplying goods to, suppose, Divya. Okay, she is registered as well as I am registered. Now, when I'm supplying the goods, I had to charge in the bill, I had to charge in the invoice actually 15,000. 15,000 rupees I had to charge in the invoice. On that GST I had to charge and I had to give it to Divya for the goods that I'm selling. But what happened? By mistake, I have written 10,000, or I thought that the value of the goods is 10,000. So I wrote 10,000, I charged the GST and I gave it to Divya. Later, I realized that the value of the goods was 15,000. So on the balance 5,000, okay, I'm going to issue a debit note. So I'm going to issue a debit note. Okay, I'm the supplier. I'm going to issue it to Divya for the balance 5,000 rupees, and on that the GST I'm going to charge and I'm going to issue. So this debit note also is as a document for claiming ITC by Divya on that 5,000 rupees. So debit note should be supporting that ITC which is being claimed. So in short, it is nothing but when the tax invoice what is issued for the supply of goods or services, that is I'm supplying to Divya. Okay, suppose if the value or taxable value is found to be less, as I told you, I'm feeling that the value is less. Okay, then on that value by which I have charged less, I can issue a debit note. So debit note is basically issued by the supplier in order to, if he is wrongly charged the tax or wrongly charged the invoice value which is at a lower side. So in order to recover the amount back from Divya, in my example, I will issue a debit note. Next is bill of entry. Now, what is the meaning of bill of entry? So bill of entry is nothing but when okay. Next, an invoice issued under certain circumstances, like the bill of supply, issued instead of tax invoice if the amount is less than rupees 200, or in situations where the reverse charge is applicable as per the GST law. So what happens is bill of supply. Now, what is the meaning of bill of supply, students? Bill of supply is nothing but, suppose if any dealer is supplying the goods which is not taxable under GST. When I say not taxable means he is registered under GST, but he is not going to charge any GST amount in the invoice. At that situation, he is going to issue a bill of supply. So bill of supply is issued by a composition dealer, because in case of composition dealer, what happens? He does not charge tax in the invoice to the customer. Okay, he's selling the goods, he's paying tax to the government, but whenever a composition dealer is selling the goods to a customer, he does not charge tax in the invoice. So composition dealer issues a bill of supply. Then you can say in case of exports, we know that there is no GST, the zero rated supply. So exporter is registered under GST, but he's not going to charge any tax in the invoice, therefore he issues a bill of supply. Exempt person who are dealing in exempted goods and services, they are registered under GST, but they are not charging any GST in their invoice, therefore they issue a bill of supply. So in short, what is bill of supply? A bill of supply is issued when GST is not applicable on transactions, or when GST is not to be recovered from the customers. That is the time bill of supply is given. Next, an invoice or credit note issued by the input service distributor as per the invoice rules under GST. Now let us understand what is input service distributor, students. Okay, suppose I have a showroom. Okay, suppose I have a Bata showroom which is all over India. Like I have it in the state of Maharashtra, I have it in the state of Karnataka, I have it in the state of Madhya Pradesh. So my showroom is there in all the states, all over the states. Now, and my main office is in Maharashtra. So what happens is I procure goods, okay, from all over India. So which state should get the input credit? The question lies here. And it becomes very tough for me to allocate the credit to the respective states. Therefore, I will appoint an input service distributor. So what this input service distributor will do, he'll distribute the inputs. Okay, he'll distribute the input to different states, okay, based on the turnover of different states. So when he's distributing the input credit to different states, he will issue an invoice or credit note. So that particular state, suppose the state of Maharashtra, suppose the state of Karnataka where my Bata showroom is there, that Bata showroom can claim the credit only when he's having an invoice or credit note which is issued by the input service distributor. Next, a bill of supply issued by supplier goods or services or both. This we have already seen. So this is nothing but the documents that is required for availing ITC. So this is supporting the first condition where it is that the purchaser should be in possession of the document. So is this understood by everyone, students? Yes? Did everyone understand what is the meaning of ITC? What are the basic terms and conditions for availing ITC? Yes?
Yes, ma'am.
Yes, ma'am.
Okay. Next, let us see in case of capital goods. Okay, what is the ITC that we can claim? This is covered under section 16, subsection 3. Now, what is capital goods? Capital goods are those goods whose value is capitalized in the books of accounts and they are used in course or furtherance of the business. Okay, ITC cannot be claimed on the tax amount on which the depreciation is being claimed. So what does this exactly mean? That no ITC will be allowed if depreciation has been claimed on the tax component of capital goods. Now students, see, as we know that when we purchase a capital goods, that is an asset, there is a depreciation attached to it. Every year the value of the asset keeps on diminishing. Okay, so we charge depreciation to our P&L account, right? Now depreciation helps to reduce our profit, correct? Because when we charge depreciation to our P&L account, it reduces our profit. So government says that I will not give you both the benefit. I will not give you the benefit of depreciation and input tax credit both. So suppose if you're charging depreciation on your capital goods, I will not give you ITC. And if you're taking ITC, depreciation cannot be claimed, because both is a, see, when you're charging depreciation to the P&L account, it is a benefit, whereas input tax credit also is a benefit. So government says that no input tax credit will be allowed if depreciation has been claimed on the tax component of capital goods. So only on the tax component, again, if you're claiming depreciation, no ITC will be allowed. So let us see the example for this. Suppose the cost of capital goods is 500 rupees, GST is 50, so total amount is 550. If you're charging depreciation is charged on 550, suppose if you're charging depreciation on the value, total value of the asset, including the tax 550, okay, then you cannot claim ITC. Why you cannot claim ITC? Because as per section 16, subsection 3, if ITC is, if suppose depreciation is charged on the tax component, this is tax component on which you can get ITC. Now if depreciation is charged on this 50 rupees also, you are not going to get ITC. Second example, where the cost of the capital goods is 500, GST is 50, total cost of the asset is 550, but you're charging depreciation only on the cost, excluding the GST component. So your depreciation is charging only on the 500 rupees, excluding the tax. You can claim ITC. Why? Because depreciation is not charged on the tax component. So government says that if, see, ITC also you will get of the tax that you're paying, and depreciation in case you're charging including the tax, then you will not get ITC. And if depreciation you're charging excluding tax, then you can claim the benefit of ITC for purchase of capital goods, because only in case of capital goods we have depreciation. In case of inputs, there is no depreciation. Depreciation is only on the assets. So is this particular slide clear, students? Yes, students?
Yes, ma'am.
Okay. Next. Section 16, subsection 4 says that time limit for taking ITC. Now, what do you mean by that? Suppose I made a purchases today. Okay. Today is 3rd June. I made some purchases. Suppose if government didn't keep any time limit. Now today, if I made a purchases, I paid a tax, input tax of suppose 10,000 rupees, and I'm like, I can use this 10,000 anytime. Okay, there is, if government didn't keep any time limit for using this 10,000, then I would say like I'll use this after 5 years, 6 years. So to avoid that, government has kept certain time limit for taking ITC. So let us see what is time limit. Suppose in case of first time, now in the case of first time means first time you're purchasing any goods or services. Suppose today I'm purchasing any goods or services. What is the time limit for taking the ITC? So ITC for a particular financial year can be taken only up to due date of filing September month's return of succeeding financial year or date of filing annual return, whichever is earlier. So students, what happens here is due date of filing September month's return of succeeding financial year. What is the meaning of succeeding financial year? The current financial year, the year ahead to that. So suppose if it is 2021, okay, then the succeeding financial year will be 21-22. So the due date of filing September month's return. Always remember, every month's return is, just give me 2 minutes, students. Okay, so the due date of filing September month's return, that is suppose April 20 to March 21 is a financial year. Okay, then April 21 to March 22 is the next financial year. So from April 21, September month, that is September 21's return, the due date for that is usually 11th of October. So this, what is the due dates of filing the returns, that I will be separately dealing, but just remember every month's return is filed on the 10th of the succeeding month. Okay. Or if it is GSTR1 and if it is GSTR3B, it is filed usually on 20th of the succeeding month. So September month's return is filed in the month of October. So the due date shall be, the ITC can be taken up to October of the succeeding financial year or date of filing annual return, whichever is earlier. Usually annual return is filed on 31st December of the succeeding financial year. So April 20 to March 21, this financial year, that is the current financial year, annual return is usually filed in December 2021. So in the next succeeding years, December financial year, the month of December 31st, the annual return will be filed. Okay, so whichever date you're filing the return, suppose September month's return or date of filing annual return, whichever date you're filing the return, which is earlier, on up to that date you can claim your ITC. So in short, up to October or December, whichever earlier, those are the due date, students. Due date means that is the last date to file return. Suppose annual return, if you file in the month of August itself, so up to August you can claim your ITC. So these are the due dates. But if you're filing before the due dates, okay, then you can, if you're filing before the due dates, then you have to check whichever date is earlier. Up to that date, you can claim the ITC for a particular financial year. Obviously, for the month of September month's return, you cannot file before September. You need to file after September itself. So just you have to compare October, or the due date of filing annual return is usually December. So October, or if you filed the annual return before October, just compare and whichever is falling earlier, that will be the date on which up to which you can claim your ITC. Next, in case of recredit. Now, what is the meaning of recredit? I'll explain you. In case of recredit, any time as and when the payment is made, no time limit for recredit. Now, let me explain what is the meaning of recredit, students. Suppose, okay, you have claimed the ITC. In GST, how does it work is, if the supply, as the system is very transparent, the supplier has to upload the invoices, okay, in the form of GSTR1. See, GSTR1 is for output tax. So the supplier will upload the invoices online and the purchaser can take the credit of that, okay, only if he is making payment within 180 days. Now, what is this? I'll just explain to you all. I am a purchaser, okay, and I have purchased the goods and services, suppose goods or services. Now, I am supposed to make payment to the supplier within 180 days. What happens? I have not made the payment, but still I have taken the credit of that before 180 days. I'm allowed to take the credit before 180 days, even if I'm not making the payment. Suppose 180 days is lapsed and still I have not made the payment to the supplier. Then the government says that whatever credit you have taken, you have to reverse it back. You have to give it back, okay? And you can take the credit only if you have made the payment. Now, suppose 180 day has lapsed, I have reversed my credit. Later, after some months, I have made the payment. So government says, once you have made the payment, you take the credit. So again, I take a credit. So here I have taken credit 2 times. Once I have taken and reversed it, and the second time I have taken credit on the same goods or services after making the payment. So it is called as recredit. So in that, when I'm taking recredit, there is no time limit for claiming ITC. I can claim that ITC on the recredit anytime. So anytime as and when the payment is made, I can claim the ITC in case of recredit. So this is the time limit for taking ITC in case of first time. First time it will be due date of filing September month's return of succeeding financial year or date of filing annual return, whichever is earlier. In case of recredit, you can take the ITC anytime. There is no time limit in case of recredit. So students, is this clear, time limit for taking ITC? Yes, students? Yes?
Yes, ma'am.
Now, this rule 36, rule 37, what I was talking about in case of recredit tells us the meaning of recredit. So let us understand the meaning of recredit. I've already explained, but let us just go through this slide. Recipient availing ITC should make the payment of its purchases to the supplier within 180 days. In case the recipient fails to make payment within 180 days, the ITC taken by the recipient will be reversed and added to the output liability in that month's return in which 180 days expires. Interest will be paid on the ITC availed. Further, ITC of the same can be taken as and when the payment is made only on the tax amount and not on the interest amount. It's called the recredit of ITC. So why it is called recredit? Because we are taking the ITC for the second time, okay, on the same goods or services. So it is called recredit of ITC. So there is no time limit for recredit of ITC. Did everyone understand the meaning of recredit? Yes? Yes, students?
Yes,
Did
ma'am.
everyone understand what is recredit of ITC?
Yes, ma'am.
Okay. Next, let us see what is the manner of utilization of ITC. See, we know GST, there are 4 components: IGST, CGST, SGST, UTGST. And SGST and UTGST are interchangeably used. If it is state, you use SGST. If it is union territory, you use UTGST. Now, GST came into picture on 1st of July. So from 1st July 2017 up to Feb 2019, this was the manner in which you was utilizing ITC. So suppose you are making payment. This is output tax. Suppose you are making payment for IGST, CGST, SGST, UTGST. How are you going to use the credit? So first, in the old rule, it was you use under the same head. So IGST is first, payment of IGST, okay, was first being set off from the IGST credit. Payment of SGST was first to be set off by SGST credit. Payment of SGST and UTGST was to be first set off by making from the credit of SGST and UTGST. Suppose if IGST output tax is more and IGST credit was less, the balance could be taken from or could be set off from SGST or UTGST credit. And in case of SGST credit, it can be taken from IGST, and SGST, UTGST from IGST. So in short, first government says when you have to make output tax under any particular head, first use the credit of the same head. And if the credit of the same head is falling short, then use the credit of the succeeding head. Succeeding head means in case of IGST credit is falling short, then IGST payment can be set off by CGST and SGST credit. Now if SGST credit is falling short, the CGST credit is falling short, then you can take the balance amount from IGST. And from SGST, UTGST credit is falling short, you can take the balance amount for set off under IGST. So from this, what do we understand? That CGST credit cannot be used for SGST payment and SGST credit cannot be used for CGST payment. So this was the old rule. Now as per the new rule, okay, that applies from Feb 2019, what government says that the payment towards the different heads, that is IGST, CGST, SGST, has to be first made from IGST credit. Means first you have to make IGST credit nil. Okay, after using IGST credit, if still payment is remaining, then you can, and if credit is available, then you can take the credit from CGST and SGST for making payment of IGST, and CGST for CGST payment, and SGST for SGST payment. So always first credit that you have to use in the new rule is by taking the IGST credit. If IGST credit is falling short, then you can borrow it from CGST and SGST in case of IGST payment. In case of CGST payment, only CGST, and in case of SGST payment, only SGST. So from this also, what do we understand? We understand that CGST, for CGST payment, SGST credit cannot be used. For SGST payment, CGST credit cannot be used. So only the difference between old and new rule is, in case of old rule, first you had to use credit of the same head, and as per the new rule, first you have to use IGST credit and make it nil, and then if balance is remaining, then you can use it from their own head of payment, own head of credit. So is this clear, students? Manner of utilization of ITC. This particular module is complete theory module. Otherwise, I would have shown you all one problems on this. But if required in my next class, just for your practical understanding, I will show you a problem on this, that how exactly you are going to set off the credit against the output tax. Is this slide clear, students?
Yes, ma'am.
Okay.